Welcome. Today is number 9 of the 14-day passive income challenge, and I'm happy to be here with you. Today we're going to discuss another element in the leverage part of the ALM model, which is attract, leverage, and manage. We covered all the elements of attract. Now we're in the middle of leverage, and we're going to discuss today about the difference between investing your money, saving your money in a tax-efficient strategy versus doing it in a non-tax efficient strategy. For most people, in my experience, they would say, big deal, I only pay taxes when I earn money. I don't have to pay taxes when I don't earn money. While they might be right that it's better to make money in a taxable environment and still pay it than not to make any money, but let's see the difference between making it in a tax efficient environment versus earning it in a fully taxed environment. Let's jump right in. Let's assume for now that you have an account with $100,000 in it. Let's assume for this situation, just for simplicity reasons, that we are taxed in a 50% tax environment. Just for simplicity reasons, so we have easy numbers, easy calculations. I love easy. And let's assume for this situation that you're going to earn 10% on your money a year, 10%. That means if you earn 10%, oops, this shouldn't be red. If you earn 10% a year, that means that your account will double in value by when? When will the $100,000 be double? And for that, I'm going to use the rule of 72. In case you don't know what the rule of 72 is, we take 72 divided by 10 equals 7.2, which tells me that in 7.2 years, this fund will be worth $200,000. Okay, you with me so far? So basically, we know one thing. In 7.2 years, instead of $100,000 here, we have $200,000 here. The question is, how much of that is yours? And what I will tell you is that if we're talking about a 50% tax bracket, that means half of that is yours, and half of that belongs to our rich Uncle Sam. So $100,000 goes for Uncle Sam, and $100,000 goes for you. Beautiful partnership, 50-50, $100,000 for me, $100,000 for them. Now you will tell me, of course, yeah, that all this could be true, but I'm not getting this money in one lump sum. Every year it grows a little bit. And you might be right, depending on the investment strategy. But if it grows every year, that means every year you pay your portion. Every year, 50% of the profit goes for Uncle Sam, 50% of the profit goes for you. It's no big difference. Versus if you have that in a tax-free or a tax-efficient environment, most of it or all of it or some of it could be erased and could be reinvested for you. So it's very, very important that anything you do when it comes to your passive income plan should be in a tax-efficient environment as much as possible. Real estate could be a good example. Sometimes it has a lot of tax efficiencies, but there are many, many other examples that we're not going to go into too much details in this day 9. But at least we know that we should focus on tax-efficient vehicles as much as possible. Hope you enjoyed today's lecture, today's challenge. We talked about tax efficiency. Let me know in the comment section below if you have any thoughts, if you agree with me or you have any disagreement, you have any better strategies and examples of strategies that you used or others use to improve the tax efficiency of their passive income plan, and let's all benefit from it. And as I told you before, I'm reading every comment and I'm replying to every comment. So let's have a conversation down below in the comment section, as well as if you want to get updates on the passive income strategy videos that we do, please subscribe underneath this video. And I'm looking forward being with you on this exciting journey.